Okay, and welcome back, students who are taking Math for Business and Finance and Math Applications. And this here is the Chapter 21, Stocks, Bonds, and Mutual Funds chapter. And in this video, we'll be covering, and this is, of course, theory, so we'll be covering mutual funds in this video. And for those with sharp eyes, you may have noticed that in one of the other videos, I had made a mistake because I was like, okay, I only have 5 videos. How come I was looking at number 6 in the last video? Okay, so if you have sharp eyes, that's what that is. Doesn't matter. Still covering the same material. And again, if you don't understand something, because I went through it relatively quickly, even though like that one video for bonds is 20 minutes, I could have broken it up and chose not to. Okay, so this will be the last video, and it'll be for mutual funds. And let me get down to it. If you don't understand something, definitely feel free to speak with an instructor. Okay, mutual funds. Now, mutual funds, right, have to do more with stocks. Okay, you buy individual stocks. Right, you can buy, let's just say, Microsoft, Google, Apple, Dell, whatever. Okay, you can buy these individual stocks. But realize that if you're taking and you're putting 100% of your money into the stock, into Microsoft, say, okay, it's all tied to that. As it goes up, you're getting 100% increase, and if it goes down, you're getting 100% decrease because all of your money is in that particular stock. And people, the general public, they're not financially educated, which means investing in the markets, it's very risky for them, and that's why people are so afraid of the stock market, because they don't have the education. So what happened is at one time we had pensions, right? You'd work for a company and they would take care of you after you retired, but that no longer exists. And because of that, a void needed to be filled, because if people need to take care of themselves, they're being told. That's why 401ks have been created, okay, for people to take care of their own retirements, put money aside for their own retirement. But what good does that do you if you're not financially educated, right? You might as well just burn the money. Okay, so what ended up happening is this idea of a mutual fund, and they have it has become very popular, and that's what is being used in your 401ks. And what a mutual fund is, it's a selection of a whole bunch of stocks. Different funds operate differently. Okay, so this is one of these things where we can't be exactly specific. It all depends upon the fund, but there's a lot of different funds. Why? Because they're all vying for your money, and they're all offering different features. So a mutual fund can have what they call a basket of stocks. The number of those stocks and the makeup of those stocks is all determined by the mutual fund. It can have 30 stocks, it could have 50 stocks, it could have 100 stocks. Obviously, the more stocks in that particular fund, the more diversification is diversification. The more diversification you have, meaning the more your risk is spread out. Because obviously, if you have, let's say you only buy one stock, right? And that one stock goes down to zero, you lost 100% of your money. But if that one stock happens to be part of a basket of 100 stocks, well, if that one stock goes down to zero, you still have 99% of your money, because it's diversified over those 100 stocks. But that's a two-edged sword, because conversely, if one stock, right, goes up 100%, okay, well, that's only 1 out of the 100 that's going up. The other 99 aren't going anywhere, okay? So, that 100% return over, that you make on that one stock, you have to consider within the terms of 100 different stocks. So really, you're only getting a 1% return. Even though that one stock went up 100%, it's only really, it only means you're getting, it went up 1%, right? And that's important because, let me erase here. And that's important. This idea of diversification is important because if I have 100 stocks in the basket, okay, and one stock goes up 100%, right? So if these are all, so to give you some visual here, this is 0, meaning 99 of these stocks have not gone up or down, and one stock goes up 100%. When we divide the 100% by the 100 companies, that means you're only getting, it's only increased 1% over the course of those 100 stocks. And this is important because why? Well, it comes down to commissions, okay? Depending upon the mutual fund that you have, they have what's called a no-load fund, or there's no sales charge on, as a commission for that, for being in that fund. And obviously, that makes a lot of sense because they're not charging you commissions, right? But try and find them; they're far and few in between. Okay, but there's also called a low load fund, right? Where they're charging 3% or less. And then there's also called a load fund, which charges 8.5% or less. Now there's a maximum that they can charge, and there's the variety that they and the fees that they have, and different things, the percentages that they use can vary greatly. So if your one stock went up to 100%, which means your entire portfolio in that mutual fund, all right, your entire portfolio, that's the word I was looking for, in that mutual fund, your mutual fund only ends up going up 1%, right? It goes up 1%. Well, guess what? If you're in one of these, if you're in, maybe you have this low fund of 3%, and let's just say they charge 3%. Well, now they're taking 3% out, and you've just wiped out your gain, and actually you're losing 2% because 3% less 1% gain, okay, means they're charging you. You're only, you're losing. Actually, I should have done it this way. They're taking out 3%. You made back 1%, so you're actually losing 2% on your mutual fund. Okay, and if that was 8%, well, now you'd be losing 7%. Okay. Well, you say, well, if I was in let's say I'm in the no-load fund, right? Okay. Let's say you're in a no-load fund, and your entire fund goes up that 1%, and you're in this no-load fund. Well, maybe the fees that they charge total to 2%, right? When you look at it as an aggregate. So if they charge 2% in fees, even though it's there's no sales charge, meaning no commission, you still end up losing 1%. Okay. So just be aware that that's how mutual funds work. And a lot of people say, well, my 401k, I'm putting it into this 401k, and the company, for every dollar I put in, right, the company is going to match it with 30 cents, right? In other words, 30%. Okay, so if I put in $1 plus my 30 cents, right, I actually have $1.30 going into that 401k. That 30% is pretty good. Well, yeah, that's fine. Okay, so let's just say, as a percentage wise, you know, you have, you're getting that 30%. Okay, because your company matches, or contributes to your 401k for that. Okay, now, depending upon the fund you're in, they're going to take out, let's just say 3% for commissions, and let's say they take out an additional 2% for fees. Okay, and let's say the market goes down. All right, and it goes down big time. It goes down 25%, and we all know that's happened. Now, where are you sitting at? Oh, you're sitting at break even. Okay, so you didn't make any money, you didn't lose any money, and so to a certain extent that's a good thing, because people who are not financially educated, okay, they would have just taken the $25 hit in the stock market, or they might have lost 100% of their money. Who knows? Okay, but you're not really losing or gaining, in this particular scenario. So in theory, your money is safe. Right? I'm not knocking mutual funds, but to be honest with you, if you look at the statistics, 96% of mutual funds lose money. Okay, 96% of them lose money. And so you're sitting there going, well, I have this 401k. I'm not saying don't do mutual funds, don't do 401ks. I'm not saying that. What I am saying is pay attention to what you're doing. You can't just stick your head in the ground and give your money to somebody else to take care of it, because if you do, you're going to lose money. Okay, and that's not what you want for your, especially for retirement. Okay, but with all said and done here, mutual funds are nothing more than a basket of stocks. And because of that, diversification takes place. And diversification is a double-edged sword. Okay, it stops you from losing money, but then again, when you gain money, you don't gain as much either. It's meant to keep everything in an even keel. Which now brings me to one final point about this: inflation. If you end up at break even in your mutual fund, just over time, the price of groceries going up, gas going up, bread going up, whatever, electric going up, whatever, now you're losing money in your mutual fund. I mean, your mutual fund, if you put in, say, $10,000 and you don't get any return, okay, inflation eats away at you, and you're no better off, you're actually falling behind as you move forward. Okay, so that sounds like doom and gloom. It's just the reality of it. But the good thing is if you become financially educated, okay, and that's why, having this in this chapter is a good thing, because it's you have to start somewhere. Okay, financial education has to start somewhere, and you're responsible for yourself. And if you become financially educated, there are funds, there are places to put your money where all of this doesn't occur. Okay, and I'm not going to tell you about them. That's your own thing to go out and learn and find that on your own. All right, I can't make recommendations. I can only just because obviously for the legal liabilities, I can only let you know about concepts, ideas, and try to point you in the right direction. But there is information out there. There are funds and stuff like that where people are getting 8%. And 10%, and certainly beats having your money in stocks getting no dividends, okay, and taking the risk of, the stock, going down to zero. Right? All right, but anyway, beyond that, you will also see, just like you did with stocks and bonds, you can also see in the newspaper quotations on mutual funds. Okay, why? Because mutual funds are part of the market, right? They go up, they go down. And there's this concept called net asset value. Now remember, we're talking about a basket of stocks. So you have your current market value of your fund's investments minus its current liabilities divided by the number of shares outstanding, right? So you have a current market value of the fund's investment. So if you have 100 shares, what's the current market value of those 100 shares, those 100 companies, okay? And then you're going to subtract out the current liabilities, okay? And you're dividing that all by the number of shares outstanding, right? Again, this is something for future subjects. You just need to get into the idiosyncrasies of it. Just realize that, when you're looking in the newspaper, that net asset value is going to be quoted. The math is already going to be done for you in the newspaper. Or, when you go online and you look at, ticker symbols, or, through websites, or even in your own 401k, you'll be able to see the net asset value. So the funds are quoted, right, by whatever fund it is and its subgroup, okay? Because why? They have the funds themselves, not only do they change the stocks that are part of the basket, but some stocks are more riskier than others, okay? You might have stocks that are in emerging markets, right? Well, emerging markets are very risky, okay? So a particular fund, might be more risky, but then another fund might have, the stocks in it like Microsoft, which are relatively safe and stable, okay? Again, if you're in emerging markets and they go up, your return is going to be a hell of a lot greater because Microsoft doesn't move that much, okay? It all depends upon the type of fund you're in. So the funds themselves have sub funds. In other words, they break it down into different categories, and that is also designated under the fund. Then you have your net asset value and the net change, okay? And you have year-to-date percent return. So in this case here, it's 8.9% year-to-date return for this particular fund. And then they also like to quote a 3-year percent return. In this case here, they're showing it as 91.6% return, saying, oh yeah, that particular fund has been doing great. I mean, that's phenomenal. I mean, you're talking 25% a year, okay? Based upon what you're seeing here. I'm not recommending this as a fund. It just happens to be information in the textbook. There are funds that do perform this well, all right? But you're the one who's looking at it, okay? If you turn your money over to a 401k, you're going to have somebody else, in your HR department who is bound by the funds that they're able to use because of the 401k, and you may not find that particular fund may not be part of your choices, all right? That's something that has to do with HR, and they're savvy and they're looking for what's best for you, okay? But so that's looking at all these mutual funds, all right? And again, to keep things relatively simple, mutual funds are generally put into they're a basket of stocks, and whether those the basket of stocks, they have conservative and they have more risky ones, okay, depending upon the fund, which means you're going to have more steady eddy, or you're going to have some ups and downs with the risk. But in all cases, commissions are being taken out, and there's also fees that are going to be applied, okay? And so remember, when one particular stock goes up, right, that means it's diversifying across all the stocks in that particular basket. And the same thing with if it goes down, it going down, that risk is diversified across all of the stocks in that particular basket, right? And then they take out commissions and fees, and what you're left with is what your return is, okay? All right, so that's it with mutual funds, and I will see you in the drill problems and the word problems and the summary practice test problems. And even though in these videos for stocks, bonds, and mutual funds, I've given you a lot more information than what was in the textbook, what you'll get in the chapter problems will be more akin to what you need to know for this particular chapter and for this particular subject. But realize that whatever you're looking at, the amount of knowledge that you need grows exponentially, and the depth that you can go into each one of these grows exponentially. Okay, it's not as simple as an easy, I read this chapter and I'm an expert. No, this is just you read this chapter, and it's sort of like saying, okay, here's an apple. Okay, well, do I know everything that there is to know about apples? Obviously not. Okay, so with that said, if you have any questions, feel free to call and, speak with an instructor. I mean, we'll entertain your questions. Okay, obviously we can't give stock advice, bond advice, or mutual fund advice as to particulars, but we're we several of us here do invest, and so we have some experience as to how things work and so on and so forth, and we don't mind sharing the knowledge and guiding people. Right, so I will see you all in the drill problems.